Hi everyone, and welcome to the Buffett and Beyond Research Saturday ETF report. And what a week it's been. And this is August 3rd, 2024. Remember, if you want to live on the beach like Jimmy Buffett once did, you've got to invest even better than Warren Buffett does now. And folks, if you want a free subscription to these letters, because you ask a lot of questions about these, you can get a full free month subscription. And we've updated our 7-day free subscription to a full month. And you get 4 daily letters each week and 3 videos each week. All we need is your name and email, and that's it, folks. Just sign up. You'll get a full month's worth of what we're talking about and the strategies that we use. And just go to buffettandbeyond.com, and Buffett is spelled with 2 F's and 2 T's, buffettandbeyond.com. Okay, here we go. QQQs. We're looking at the QQQs, and what a past couple of days, Thursday and Friday, has been, and all week was weak in here. All week was weak. Yeah, and now we have the 20-day moving average crossing over the blue line, which is the 50-day moving average, and that's one of those death crosses that they talk about, so it's not a good sign. That was Thursday, that fall, and then Friday, the fall continued with the intermediate term indicator pointing down, very, very much oversold. And these bars in here, these red bars, that represents the volume when the market is down, or when the QQQs are down for the day. And you can see a lot of red in here, so it doesn't look too good, folks. And let's look at the technology sector. Remember, we're talking about ETFs here. Technology sector, well, we got that crossover in here, not looking good, and then on Friday went down to touch the 200-day moving average, which is not good, but at least it bounced off it. Now when we look at the semiconductors, same type of thing, same type of, this is almost crashing in here, fell below the 200-day moving average, and that's a lot. That's a signal for a lot of people to start selling. But it didn't happen on the major indices, just the semiconductor ETF. So when we look at the housing sector, we're just going to look at a couple of ETFs, and then we're going to show you how our portfolios did and how our hedged portfolios did as we go on. The XHB, just the past 2 days, Thursday and Friday, it started down because it was doing very, very well as interest rates started to come down, and everybody was happy until Thursday, and then Friday fell below the 20-day moving average. And you can see this indicator down here just starting to turn over to the downside. And we bought some of these stocks in our trading portfolio. Now we're usually buy and hold, so we have portfolios that are buy and hold, and we hedge those, and then we have some short-term trading for those of you who want to do a little short-term trading. And when we got into this area here, we got rid of some stocks that we made some really nice money on, folks. Wow, these worked out very, very well in here. We got the buy signal down here, and now it looks like we're getting the sell signal. So we got out in here a little early as this black line started turning down a little bit. We said, okay, goodbye. We got some money, and we're out of there. We missed a nice move up, but then we totally missed the down move too, which is a good thing. Let's look at energy. Was there any place safe to hide? Not in energy, and it gave it a sell signal down here also. It's about to touch its 200-day moving average. And again, a lot of people, a lot of traders, a lot of mutual fund operators look at that 200-day moving average. Now, let's look at the utilities. Did anything work? Yeah, the utilities, and they're acting like bonds because utilities have fairly nice dividends. And what people are doing now in the market is they're selling stocks and they're getting into bonds and utility stocks because they have fairly high dividends, and the utilities have about a 3.2% dividend. This XLU does, the ETF does about 3.2%. So the people who buy stocks or want income bond traders usually, and people who like the utilities because they pay dividends, they will get into them now because they see with this stock market going down like it is that the Fed is going to be forced to lower interest rates. So they're trying to lock in higher dividends and higher interest rates in bonds. So higher dividends in stocks, higher interest rates in bonds right now. And this is why you see the utilities going up right now. And then when we look at consumer staples, what? Consumer staples for real? It's going up and doing very, very nicely. Well, what's a consumer staple? All right, let's look. Yeah, we're looking at stocks like Procter & Gamble, Costco. Costco's even in our growth portfolio. Walmart, Coca-Cola, Philip Morris, Pepsi, Mondelez, Altria, Colgate-Palmolive, and the Target Group. And we have some nice returns in these stocks, folks. But let's look at a chart over 1 year. Black line is the S&P 500. So if you bought into the XLU, you would be underperforming by almost half of the S&P 500. And this is as of Friday, close to the close. And then down here you have the consumer staples, which is up only about 4% in the past 1 year. Now it's been doing good year to date because the year to date started about in here, so it looks very nice. But when you consider the full 12 months, past 12 months, we're not doing so hot. Let's look at 5 years. Black line again, S&P 500, and these two down here, the consumer staples in here, the utilities in here, do not count the dividends. So if you include the dividends here, the utilities would be up about here where the staples are, and staples would be about 45%, still about half of the S&P 500. So if you want returns, folks, it's hard to get into anything other than the S&P 500 or the QQQs or the portfolios we're about to talk about right now. And let's look at our sector stars. And the sector stars consist of about 18 stocks, and we've picked these stocks from various ETFs, and you could do that with our computer program. That's so good about having access to our computer program. You could pick the stocks with the highest return on equity, clean surplus return on equity, that is. We're the only computer program in the world that has that. And we can see that the sector stars are up about 15%, while the S&P is up about 11%. But if you hedged and you were following our hedges all year long, you would be adding another 6.2% to this entire portfolio. So you would be up about 20%. So we're doing pretty well in here, folks. Again, the QQQs are up 9.6%, S&P up 11.9%, and our sector stars, if you used hedging, which we like to do, you would have about 20%. If you didn't use hedging, you'd still be up 15%. You would still be up more than the QQQs themselves and the S&P 500. So this is not a bad portfolio, folks. In fact, if you're doing better than the S&P, you are one of 4% of people that can outperform the S&P over any 10-year period. Yeah, 96% of professional money managers cannot outperform the S&P 500, this thing right here, over any 10-year period. And that's a Morningstar report from 2002, and it's held true to this day. Now let's look at my favorite portfolio, and we're looking at the NASDAQ. And out of the NASDAQ 100, we picked about 11 stocks. And folks, this portfolio is up 20.6% this week as of Friday morning. And if you were hedged using the same hedges that we used in the last portfolio, you'd be up about 26.2%. Folks, that's phenomenal. With the S&P up 11.9, we're more than doubling if you're using hedging. And we only hedge about 30% of the portfolio. So we use an inverse ETF, and we put 10% into that ETF, and it gives you 3 times the return. So if you followed us all year long with hedging about 30% of the portfolio using only 10% of the money, we would be gaining another 3% over last week. and that shows up right down here, up 26.2%. Now let's go back to the sector stars, and the question is, what about our 30 stock growth portfolio? Would a person rather be in the 30 stock growth portfolio or the sector stars? Right now, folks, they're returning about almost the exact same thing, and if you hedged the portfolio, you'd be up another 6.2% for the year. Now, if you have these portfolios, they're not exactly the same as yours, because what we do is we take an equal amount of money and put it into each stock. We don't put 100 shares of each stock. We take the same amount of money. In other words, it's weighted toward monetary. Monetary weighting is what they call it. So you put the same amount of dollars into each one of these stocks. And we used to have a portfolio or brokerage company that allowed fractional shares, and Schwab allows something like fractional shares for individual accounts. But that aside, we're doing very, very well no matter how you look at it, folks, whether you're hedging or not hedging. And let's go to the QQQs. If you're not hedging, you're up 20.6%, with the market itself up 11.9%. So, folks, we're doing very, very well. If you're hedging, you're adding another 6%. So not too bad, is it? So, folks, we had a tough week this week, really tough. And Thursday and Friday were just terrible days to be in the market. But we had hedges, and so we did pretty well in our short-term portfolio. We also did some option spreads, which limited the amount of loss, and we're still ahead in that portfolio for the year. So, hey, it's the weekend. Go out, enjoy yourself. Forget about the market. Go to the beach. Go walk on a golf course. Be with your family. Have Sunday dinner. Watch television. Do whatever you want. Take your mind off the market, because don't forget, we'll be back here in a few days. So, folks, stay safe. We'll see you then.